Thanks very much for coming here this morning, guys. My name is David Semark. I'm a barrister here at Quadrant Chambers. I'm also, for my sins, the co-author of the 4th edition of P&I Clubs Law and Insurance, currently working, albeit at a somewhat glacial pace, on the 5th edition. And so Hannah asked me whether I'd be prepared to come and chat to you guys today to give an introduction to P&I insurance. Now, I've had a quick look at the list of attendees, and I think I've pitched this talk more or less correctly. Our aim today is to give some guidance to people who are either working in-house at a claims adjuster or loss adjuster, or even I know there are one or two of you who actually work for the clubs themselves, or for a claims recovery firm, or for a solicitor's firm, either on the cargo side or on the ship owner side, who has come across the concept of P&I insurance on matters that they're dealing with, have been liaising with clubs either to get security or been instructed by clubs to defend claims or on behalf of their members, and really needed just an overview of what is this insurance all about. And I'm very pleased you've accepted the lure of a bacon sandwich and a lukewarm cup of tea or coffee. Because, as I always like to say, P&I insurance is the most important insurance that nobody has ever heard about. I made an exception, of course, for people in this room. Because if there is an argument that the modern world we live in today, in circumstances where 90% of trade is carried by sea, is in fact the product of containerization and ocean shipping, there's an equally plausible argument that without marine insurance, and specifically P&I insurance, the modern world as we know it today could simply not exist. So what we're going to cover today are the following. We're going to have a look at what P&I insurance is. We're going to look at these rather strange entities called P&I Clubs, how they're structured, what they do. We're going to look at the amount of money available to pay claims, because at the end of the day, the purpose of P&I Clubs is to insure their members against liabilities. Those liabilities are extensive. We'll discuss briefly the recent case of the vessel that hit into the Baltimore Bridge, collapsed that, and is very likely to give rise to the largest P&I claim the world has ever seen to date. So we're going to look at the structure, how the P&I clubs go about creating a pot of money to satisfy such claims. We're going to look at the heads of cover. What do P&I clubs cover? We're going to look at the exceptions to cover, what they don't cover, or when the members may jeopardize their P&I cover. We'll look at some of the related insurances that P&I clubs offer, because they don't purely offer P&I terms. And we're going to discuss, perhaps briefly, how clubs deal with disputes between the managers of the club or the directors of the club and the member, for those of you who might find yourself in the middle, caught in the middle of in one of those. Right, well, let's kick off. Anybody recognize this vessel? She is, of course, the Titanic. She sank almost exactly 112 years ago this week. She sank on 15th of April, 1912. And she carried 2,222 passengers and crew. As you know, 1,496 people died, including Leonardo DiCaprio. At the time the Titanic sank, there were indeed P&I clubs in existence and in operation. And the clubs managed to survive. In fact, the sinking of the Titanic was a significant impetus to the development of the international group and the idea of reciprocal cover between clubs. But the question you have to ask yourself is, well, what happened if a ship equivalent to the Titanic sank today? Of course, in 1912, the Titanic was the largest ship of its type. This is currently the largest cruise ship in the world. And I have to say, if there is something as a ship that is too big, it's probably this monstrosity. You can imagine, of course, being here when it's level, but can you imagine it turned over on its side? And all of a sudden, you're an 80-year-old woman who has to go from this side to the lifeboat deck, which is on the other side, in circumstances where perhaps your mobility is not what it was in your youth. We can imagine that the casualty rates would be significant. The Icon of the Seas, the ship we just looked at, was built at a cost of 1.86 billion euros. She has 20 decks. She She has 9,950 passengers and crew at full complement. That's more than 4 times the amount of passengers that the Titanic covered. And of course, she's operated by Royal Caribbean Cruise Lines in Florida. But of course, if you go on Aquasis, you should all subscribe to Aquasis. It's a very useful tool which allows you to look up the management and ownership details of any ship or commercial vessel, and non-commercial vessels anywhere in the world. She's actually owned by a Florida limited liability company called Icon of the Seas LLC. Now, of course, that company's only asset will be the ship. If that ship, God forbid, was to be involved in a mass casualty, the question which would arise is, how is compensation to be paid for all the crew and the passengers who would no doubt perish in such an incident? Of course, the clubs don't just cover cruise ships. As I said, some people say that the most significant invention in the last century has been the computer microchip. There's an equally plausible case in my view for the proposition that the invention of the 20-foot standard container, which has enabled those microchips to be transported all over the world and enabled all the goods that you buy on Amazon with those microchips to be transported from factories in China to your door in South London, is an equally important development. The modern world that we know today simply wouldn't exist without the mass transfer of goods from manufacturing sites in the Far East to the West and vice versa. And of course, when we're talking about manufactured products as opposed to raw materials, we're talking about them being carried in container ships. And of course, as the market for container ships has become more and more competitive, so the owners have tried to create economies of scale by building bigger and bigger container ships. Of course, bigger ships means bigger claims if, as is inevitable, something goes wrong. So that vessel we've just been looking at is the MSC Arena. She was built in 2023. She carries 24,346 containers when fully loaded. That's a lot of Christmas presents. She is operated by MSC, as the name suggests. And if you go on Aquasis, you'll find she's actually owned by Jiang L58K Hong Kong Shipco. Good luck enforcing a multi-million-dollar award against that entity. So, because nobody would ship their goods on a vessel that was uninsured for third-party liabilities, this is where the clubs come in to pay in the event of casualties. That's a much smaller container ship. See, arrow points to fracture in hull. The reality is that as long our modern world depends, as I've tried to stress, on container shipping, on bulk shipping, our modern leisure activities are also increasingly centered at sea. And therefore, there has to be a mechanism in place to provide compensation for the claims which will inevitably arise. The sea is an incredibly dangerous environment. Things go wrong. Human nature remains human nature. People commit errors. The rise of so-called autonomous shipping is not going to change that in any way. And so there has to be some way for ship owners to pay such claims. Now, P&I insurance is not the oldest marine insurance in the world. In the old days, when ships were a lot smaller and where merchants used to actually travel with their goods on sailing ships to the foreign port together with the owner, what they would do is they would club together and insure per voyage. That then led in the 17th century in places like Amsterdam and Holland and in the Lloyd's Coffee House in London to the idea of hull insurance. So the owner would undertake to insure his own ship for a period of time against maritime casualties. And the hull clubs, the hull insurers, would pay out generally 3/4 of the value of the ship if it was involved, say, in a collision. Of course, that left the owners with a residual 1/4 risk. How to insure that? So they started forming, particularly in places like the west of England and the north of England, things which of course are still reflected in the clubs we know today, so-called hull clubs. So they got together and effectively they agreed to mutually reinsure each other for any residual 1/4 unpaid by their hull policy in the event of a casualty or a collision. And the name clubs comes from the fact that these associations predated the modern development of corporate entities, predated the Companies Act, and so they were literally unincorporated associations in much the same way as you might be a member of a golf club, or if you're male, the Garrett Club, or any other association, Lions, Rotary, whatever. Pret Coffee Club. And the name members, clubs refer to themselves as members, derives from that genesis of the organizational format. And of course, as time went on, and as trade picked up in the 19th century, other types of claims began to manifest themselves, mostly, of course, cargo claims. So what we saw in the 19th century was the development of marine cargo insurance. Marine cargo insurance would pay out to the owner of the cargo if it was lost or damaged. They would, of course, then try to claim back from the ship owner, and ship owners increasingly turned to their hull clubs for association and for recompense. So heads of cover, if you want to call it that, gradually started to be added to the hull club format, and those organizations in turn ultimately became the P&I clubs that we see today. So certainly by the late 19th century, early 20th century, most of the English clubs, whose names exist in different forms today, were already established. And of course, other ship owners, places like Scandinavia, started copying that model. And we see that when we will see the geographic distribution of the clubs when we look at the international group. But the purpose of clubs is to insure each other, and remains to insure each other on a mutual basis for liabilities which you incur as a ship owner to a third party, which arises out of the result of the operation of commercial shipping. So typically, who can claim against a ship owner? Well, governments, civic authorities, can claim for pollution caused by ship's fuel or bunkers. We've talked about the Keyscott Bridge in Baltimore. Clubs cover their members for so-called fixed and floating objects. If your ship hits the quay while during loading or unloading, that damage is compensated for by the club. If your ship is unfortunate enough to lose power and hit a bridge, that is also within the members' FFO cover. A big part of the club's function is to pay claims brought against ship owners by the owners of cargo. And of course, the sea being what it is, the clubs also exist to pay claims brought for personal injury or death by members of the crew or passengers who are injured or die on board a vessel during the course of its operation. So, of course, as I said, marine insurance, P&I insurance is not the world's oldest insurance. It grew out of and in response to hull insurance. So hull and machinery insurance is not typically insured on a mutual basis. If you're a ship owner and you own a ship, you have to go to Lloyd's of London or to a commercial insurance company who specializes in marine insurance, and they will sell you a hull and machinery policy, which covers your own ship for damage to the structure of the vessel. Hull and machinery insurance will also typically insure against collision liabilities to other ships, so third-party claims, but only up to 3/4, as I said, of the resulting exposure. Although the P&I clubs cover cargo claims, they cover third-party cargo claims, so claims made by a cargo owner or a charterer against a vessel. The cargo owner will take out its own policy of cargo insurance, and typically, as and when that claim is judged by the underwriters to be within the scope of the cargo cover, the underwriters will pay out on that claim, take a subrogation of that claim from their assured, and then seek to recover from the vessel's P&I insurance. And that's a large part of the sort of bread and butter operation of any P&I club case handler. The clubs do not cover war risks insurance. They may, to a limited extent, cover liabilities incurred to members of the crew for deaths arising out of war risks, but they will certainly not cover the owner for damage to his own ship where that damage is covered by war. So the owner has to either go out and buy war risk insurance on the commercial market, or can go to the Hellenic War Risks, which is effectively a specialist war risk mutual association, which operates quite closely and is managed by many of the same people who work for P&I clubs, but is effectively a specialist war risk underwriter. And the role of P&I insurance then is to fill in the gaps that are not covered by other policies of marine insurance. The overall aim is to protect ship owners against claims by third parties. An increasingly important aspect of P&I cover is that it also enables the owner to operate vessels in the modern regulatory environment. So, for example, under the EU Marine Insurance Directive, you cannot call at an EU port unless you can provide evidence that you are covered for P&I risks on terms which are analogous to those which are offered by the International Group of P&I Clubs. So you don't have to prove that you're entered with the P&I Club, although 90% of the world's shipping is, but you do have to prove that you've got cover in place on those terms from a reputable underwriter. And as various conventions have come into force during the course of the late 20th and early 21st century, the question of liability under conventions has shifted from a need for a claimant to prove fault on the part of the ship owner to a strict liability regime, albeit one capped at generally unbreakable liability limits. So, for example, one of those conventions, which has been in force since 2008, is the IMO Bunkers Convention. Now, P&I clubs have always covered their members against claims for pollution caused by fuel carried by oil, caused by fuel carried in order to operate the vessel's engine. The P&I clubs do not insure their members against oil pollution caused by oil carried as cargo. That is the subject of a separate compensation regime in most of the world, the United States being a notable exception, which is covered by the Civil Liability Conventions. Now, the Civil Liability Conventions, and again, one of those insurances that nobody's ever heard about, is a mechanism whereby a fund is created in order to compensate countries, governments, and claimants in the event of an oil spill when oil is carried by cargo. And those funds are not met by ship owners. They are actually paid for by oil exporting and oil importing countries. So if you operate a refinery, you will pay a levy if your government as a member has signed up to the Civil Liability Convention every year. That levy will go into a pot of money. The Civil Liability Convention Fund is administered here in the City of London. There's a very small staff, and it pays out in the event of a catastrophic oil pollution claim caused by oil carried as cargo. But of course, at any given time, if you've got a large Cape-sized bulk carrier, you could have 2,000 metric tons of fuel oil on board. If there's a breach of one of the bunker tanks, 2,000 metric tons of heavy residual fuel oil spread all over a colony of seabirds is going to make quite a mess. And so the clubs also cover oil pollution caused by that. So there's a parallel sequence of covers that has been put in place more or less by accident over the course of the 20th century. Now, when the Bunker Convention came into force, it effectively provided that an owner was strictly liable for any pollution caused by fuel carried by the ship. So there's a leak, it causes pollution damage, you're on the hook as the owner. In order to trade your vessel to a port where the Bunker Convention is in force, you as the ship owner have to put what's called a blue card. It's a certificate of insurance showing that you're covered for liabilities under the Bunker Convention. The P&I Clubs provide those blue cards to their members. And it's a feature of that liability regime that the claimants can go directly against the club. So there's no pay-to-be-paid rule, which some of you may come across in other contexts, P&I insurance. That provides a direct liability route against the club in the event of such claims. So it's really a quick and easy mechanism to ensure a seamless compensation of the claimants in the event of pollution damage carried by fuel. Wreck removal, equally, that entered into force in 2015. You've got to have a blue card stating that if the ship sinks, the P&I Club will pay for that wreck to be removed. It used to be a big problem before the Wreck Removal Convention because, of course, generally speaking, ships are owned by one-ship companies. If the ship sinks in, say, Table Bay, then and the owner disappears, and there's no P&I Club in the picture, or in the case of that particular vessel, the P&I Club is a Russian P&I Club who declines to pay the claim, then the local authority has a big problem. You either let that ship sit there, potentially causing an obstruction to navigation for other vessels, or you have to cut it up and pay for the costs of removal themselves, and that's a very expensive exercise. So the P&I Clubs effectively enable the efficient functioning of the Bunkers Convention and the Wreck Removal Convention. They also provide cover for liabilities under the Athens Convention. The Athens Convention is a convention which allows for statutory payouts in the event of death and injury to passengers carried on board vessels. Similar to the Warsaw Convention that applies to passengers carried by air. Again, it's a strict liability convention, and the clubs will provide those blue cards. So how does the club pay for all of this? Well, normally, those of you who have just reviewed your car insurance will know that in your standard insurance policy, you pay what's called a premium. That premium is set, and it gives you cover for against a defined risk for the duration of the cover. Mutual P&I clubs work on a slightly different basis. Technically speaking, if you're a member of a P&I club, your liability is completely open-ended. You're on the hook for any liabilities that the club may have, insofar as they're distributed amongst the membership. What the clubs do is they start before the start of every P&I underwriting year, which is the 20th of February. It's the 20th of February because in the old days that was the earliest date that navigation became possible in the Baltic Sea. And so that was deemed to be the appropriate date for the start of the P&I coverage year. The clubs will look at their claims record for the previous year. They will look at the underwriters will look at the forecasts and the claim trends for the coming year, and they will levy an advance call, effectively a premium on the members. So they will say, this is the amount we're going to have to pay to give you a certificate of entry with the club. And then the call is usually paid in 4 installments. There are supplementary calls, which are often levied. Very unpopular amongst the membership of the clubs are unforecasted supplementary calls. So if you have a particularly bad claims year, or indeed if another club has a particularly bad claims year and there is an overspill claim which comes down through the international group mechanism, which we'll discuss in a minute, then the clubs have the authority to go back to the members and say, by the way, our mutual liabilities are much greater than we thought, so please can we have more money? Very, very unpopular amongst the members. Generally speaking, the aim, as with any insurance company, is to generate a profit. Mutual clubs are not profit-making institutions in that they don't have shareholders and they don't pay a return to shareholders. Those profits are generally held as the club reserves, effectively a comfort band to meet particular claims. Those reserves are professionally invested by external financial managers appointed by the clubs. But sometimes there is an underwriting surplus, and sometimes the clubs will agree mutually to pay those surplus calls back to the members. Members are generally quite keen on that, managers of the clubs less so. If you leave the club, because of course at the end of every underwriting year, a ship owner is free to leave, or sometimes the managers decide they're not going to offer that ship owner terms if its loss record has been particularly bad. At the end of every renewal year, some members shift clubs. That's happening more often. It used to be that you would, if you were a ship owner, you would stick to the same club for the duration of your fleet's commercial operation. These days, people are a little more mercenary about that. But if you leave a club, you may have to pay what's called a release call for all open policy years, which haven't been met yet. That's to cover your potential exposure for supplementary and unforecasted calls. Right, so how does a P&I club work in practice? Well, as I said, they started out historically in ship owning centres like London, north of England, west of England, Bristol. Of course, these days, shipping, the days when 3/4 of all maritime ships flew the British Union Jack, are long gone. These days, clubs cover ships and ship owners all over the world. So you will sometimes hear clubs talking about syndicates. So groups of the managers, so the clubs are professionally managed by professional managers. They employ claims handlers, they employ lots of maritime lawyers, and they are grouped in syndicates, which typically serve members in a particular geographic area. Some clubs follow a model of handling all claims from a central location. Other clubs will have opened branch offices all over the world. So, for example, if you take the north of England, they will have an office in Greece, in Singapore, and in other jurisdictions as well. And the purpose of those syndicates is effectively to handle claims. Sometimes the syndicates will handle claims of a particular type. So it's quite normal, for example, for a club to have a specialist syndicate that looks after passenger claims. It's quite normal for a club to have a specialist syndicate that looks after offshore P&I risks. And there are also separate departments for underwriting and increasingly loss preventions. Typically, those would be master mariners who are employed by the clubs. A lot of the clubs have their own inspection programs, so they will go around, visit the member's office, make sure everything is running okay. They'll go on board member ships and do inspections, just to make sure that the professional standards of ship operation are being maintained. And the clubs are very proud of the role they play in loss prevention. And of course, a lot of clubs offer what's called FD&D cover or defence cover. FD&D stands for Freight Demurrage and Defence. It's effectively a form of legal liability insurance. Some clubs will employ in-house lawyers to run those claims themselves. Other clubs prefer to instruct external solicitors. But where, for example, you are covered for a risk which the club doesn't cover, for example, a typical example would be, for example, a ship owner member has a claim against its charterers for a disputed off-hire deduction. The club isn't going to pay that disputed off-hire deduction. That remains the member's risk. But the club which offers FD&D cover, where the member has taken out that head of cover, will pay the costs that the member incurs in instructing lawyers to fight that claim in arbitration or in court, as the case may be, against its charterer. And sometimes the FD&D department is a separate department. Sometimes you'll have specialist FD&D lawyers who sit in particular syndicates and deal alongside the P&I Club claims handlers. Sometimes you get claims handlers who do both the P&I side and the FD&D side. But typically, and certainly in the course of my career, it's become much more standard to have what is effectively an in-house law firm within the clubs themselves operating maritime claims. Now, there are 13 mutual P&I clubs in the world. And as I said, starting before the sinking of that Titanic, but accelerated by that, was the idea that just as the members within an individual club would club together to mutually insure risks, so the clubs themselves would mutually insure each other's against claims above a certain level. And that mechanism is brought about by another unincorporated association called International Group P&I Clubs. It's headquartered here in London. It's a very small staff. I think there are about 5 or 6 employees. But each mutual association is a member of the international group. There are 13 clubs in total, 1 American, 1 Japanese, 3 Scandinavian clubs, and 8 British. I put British, should have put inverted commas around the British section because, of course, post-Brexit, most of the clubs that used to be headquartered in the United Kingdom have opened separate underwriting divisions in other EU countries, so as to continue to insure members in the European Union. So some of the clubs that we think of the British are actually headquartered in Monaco or Luxembourg or Ireland. Anyway, together they insure 90% of the world's blue water tonnage and a large percent of the world's brown water tonnage. That's rivers, Great Lakes trading, that sort of thing. And the principal role of the international group is twofold. One, it serves as an advocacy body. So it represents the clubs and organizations like the International Maritime Organization, which is the only body of the United Nations that actually works as it should. That's the, if you haven't seen it, that's the big building on the embankment near MI6 headquarters with the statue of the chap with the standing on the bow of the ship with a rope in his hand. The International Maritime Organization is responsible for the development of a lot of the harmonization of safety and regulations, conventions like the Bunkers Convention, the Wreck Removal Convention, etc. And the International Group of P&I Clubs liaises closely with them. The other important function of the clubs is to reinsure the group members, to collectively reinsure the group members in the commercial market. So what are the consequences of sharing risk between clubs? This is a slightly controversial issue. 13 P&I clubs, they all share each other's risks. Therefore, the clubs say, well, if you want to be a member of our quote-unquote club, you have to offer similar insurance terms. So it's not open to a P&I club to say, well, I'm going to offer you better terms because I am the Swedish club and you are the UK club. The club's policy is that all members must insure on the same basis. Now, those of you who have looked at competition law will immediately pick up your ears and say, isn't that anti-competitive? At one point in the early 2000s, that was the view taken by the European Commission. The international group eventually managed to persuade them that the societal benefit of pooling P&I risks on a mutual basis outweighed the anti-competitive element in making sure that they all insured on the same terms. But it does periodically come up because the clubs cannot compete directly on price or on heads of cover. It's a term of the pooling agreement, which is a contract drawn up every year between the members of the pooling of the international group, that they don't do that. Astoundingly, there was no formal agreement between the members until 1985. So the International Group Agreement exists and is revised every year, but it's a relatively recent organization. It was done on a handshake basis from 1890 to 1985, which is quite incredible when you think about it. And they offer, collectively, cover for P&I risks up to a total of 3.1 billion US dollars. Now, that is a diagram, and don't worry, there won't be a test afterwards. But just to explain in broad terms how pool claims are structured, the pooling agreement provides that every single club is liable for claims up to $10 million on their own back. So all claims 10 million and under are met by an individual club and its members. Claims above 10 million up to 100 million are pooled under the International Group's own self-insurance program, which is run out of Bermuda by an organization called Hydra. And that offers cover between 10 million and 100 million. So effectively, the International Group Clubs self-insure for that level. For claims above the $100 million level, they are insured in 2 layers. The reason there are 2 layers is that Hydra, the group's own captive reinsurer, participates in layer 1, I think up to 25%, and then the rest of that layer is insured either in the Lloyd's market or in the commercial shipping market. So each commercial underwriting company, almost all over the world, that specializes in any way in maritime law will have a piece of the International Group's reinsurance contract. It's the largest insurance contract in the world. It's negotiated every year. So that gives cover up to $1.5 billion, which when you add up all the other layers comes to a total of $2.1 billion. And then there's a further $1 billion, which was effectively put in place after the Costa Concordia disaster, which provides an additional $1 billion of cover. Now that's called overspill insurance. So the idea of mutual P&I insurance is that 10 million goes to the individual club, 100 million is covered by the pool. There are various layers up to 1.5, and then before the Costa Concordia, if there was a claim above 1.5, that would then spill over the top and go back to the members. So in theory, if you had a claim which exceeded 1.5 billion, it would then go back to the members and be spread out and borne by each individual ship owner throughout the world on a pro rata basis. Now, there's never been an overspill claim, but after the Costa Concordia, they thought, well, hang on, 1.5 billion is looking a little light. So they went into the market and said, we'd like another $1 billion, please. The market effectively looked at this and said, well, that's a very chunky piece of change. What we'll do is we will cover you for 2 collective overspill liabilities. So there is commercial insurance for an extra $1 billion above 2.1 with a 1 reinstatement. That means if you have a claim that exceeds 2.1 billion in a given year and it wipes out or eats into your collective overspill cover, the underwriters will reinstate that 1 more time. So it will top you back up to 3.1 billion. In other words, if you have 3 claims that go up to 3.1 billion, you're not going to be covered for the 3rd one. Now, obviously, the clubs have looked at this, and it's either a commercial decision or it's a decision that the likelihood of having 3 such claims in any given year would be disastrous. It is a risk to the system, which we'll look at in a little more detail later on. Right, there are certain caps on capacities, and not all members are covered to the same degree under the boot. So your owner's entries for oil pollution is 1 billion. Passenger liabilities are 2.1 billion, plus an extra billion. Charterers' liabilities are capped at 350 million for both. Does anyone know who she is? This lady is Dominica Surmerton. She was a dancer on the Costa Concordia, had been a dancer, struck up a friendship with the Captain Scatino, and on one particular voyage came on board not as an employee but as his guest. And they decided that it would be a good idea if they routed the vessel past a particular island village where a group of their friends were celebrating a birthday party on their way to the port of Genoa. Captain Scatino thought it would be a good idea to skirt the island, blow his horn and wave at his pal. On the bridge, at which Ms. Surmerton was allegedly also present at the relevant time, despite having no obvious maritime navigational qualifications. She queried with the captain whether this was a good idea. The captain phoned his friend to say this is what he was doing. His friend, who was also a master of another Costa vessel, said, "Mate, it's a bit rocky out there. Are you sure that's a good idea?" And he said, "Yes, that's where I'm going." And as we all know, that's what happened. Hit said rock. Very, very fortunate that only 32 people died. Had the depth been any greater, the death toll would have been a lot more. But the wreck removal and disposal costs came to 1.5 billion, and the passenger and other compensation, once all the claims are resolved by the Italian courts, which maybe sometime next century, is expected to cost around another 350 billion. So call it an even 2 billion, and you'll see why the clubs thought that the reinsurance program needed an extra billion or two to the kitty. That, of course, is about to be tested again. So you'll have all seen the press reports about the poor old Dali. Terrible, terrible thing for the poor crew. Lost power in circumstances that are still obscure. Concatenation of unfortunate events led it to hit the one pillar in the bridge that would bring the entire bridge down. And there she is, still stuck there. Crew is still on board. 6 people on the bridge died. So there are certainly, this is Baltimore, this is the US, certainly going to be multi-million-dollar wrongful death suits. Current estimates for the removal and rebuilding costs of the bridge range between 1 billion and 5 billion US dollars. So those of you who've been paying attention to the structure will realize that we're already over 3.1. And if a contractor says it's going to cost you 1 billion, you can be damn sure it's actually going to cost 5 billion. Some of the research I've been doing, as there's a similar bridge up in New Jersey, that apparently cost 4 billion to build 10 years ago. So it's certainly going to blow the overspill cover of the international group program. It's squarely within FFO cover. There is, of course, potentially, and you'll have seen some of the more excited media chatter has said, oh, well, of course, what about all the ships that are trapped in the harbour? Can't they sue? Well, possibly. But certainly as a matter of English law, and as I understand it, as a matter of US law as well, that would be unrecoverable pure economic loss. So those of you who remember your tort lecture will know that in order to recover damages in tort, obviously there's no contract between the owners of the vessel and any third-party ship owners who may be stuck there, so they would have to claim in tort. And generally speaking, you can only recover damages in tort if there's a special relationship between you and the tortfeasor. And if there is not a special relationship between you and the tortfeasor, and you nevertheless suffer a result of that person's actions, that damage is generally unrecoverable financial economic loss, and so not recoverable. But those of you will say, well, it should be fine. Don't have to worry about the 3.1 billion because the ship owner can, of course, limit liability. Possibly, but the United States is not a party to the 1976 Limitation of Liability for Maritime Claims Convention. Limitation of liability in the United States is governed by the 1851 Limitation of Liability Act, and that cap for breaking liability is notoriously easy to break, particularly as most trials in which limitation of liability becomes an issue are dealt with in front of a jury. So you can imagine how the 12 citizens of Boston or Baltimore have seen their bridge come down and 6 people died will respond to any limitation action that the owners will no doubt bring if they haven't already tried to do so in the United States. Now, P&I clubs may sometimes not cover an owner if the owner's actions have led to an inability to limit liability. But they will only do so in circumstances where there is another exception of cover engaged. So, for example, if the vessel was, if the owners knew that the vessel was unseaworthy, that may fall within the improper or hazardous trading exception. If the ship was unclassed at the time, that may fall foul of the warranty of class, which underpins all P&I insurance policies. But generally speaking, if you're a ship owner and you lose the right to limit liability in the States for reasons which don't engage one of those exceptions, which may very well be the case here, the clubs are still on the hook for the claim. They can't deny their members' claim. We'll skip through that. That's just propaganda for the P&I clubs. What else? Day to day, the clubs will always say that they don't just provide insurance, they provide a much deeper level of assistance to their members than any conventional insurer would provide to their assured, and there is some basis, in fact, for that assertion. So P&I club claims handlers tend to be a lot more closely involved in negotiating, handling their members' claims than a normal claims handler would be at a commercial insurer. The clubs maintain a network of correspondence throughout the world. In the old days, those correspondence would be both legal correspondence and so-called commercial correspondence. So when I first started out, for example, I was worked for a legal correspondent in the port of Durban in South Africa. These days, most of the correspondence are commercial correspondence. The only jurisdiction where they retain legal correspondence is the United States because of the risk of litigation is so intense in that jurisdiction. But the correspondents are basically there on call so that there is somebody the club can call in any port of the world to say, one of my members is in trouble, can you go on board and speak to the master? So it's a very valuable service. And if you look at the club rule books, either online or in hard copy, they will list correspondence throughout the world. And those of you who are acting for ship owners in club-covered claims will no doubt also have to deal with the correspondence because they are generally the people you speak to get the information and the evidence you need to run the claim or defend the claim. Clubs say that because their associations are mutual, they have a bias towards paying claims rather than rejecting claims. That depends very much from club to club and indeed from member to member. To quote George Orwell, all members are equal, but some members are more equal than others. Very important function, clubs issue letters of undertaking. So if you act for cargo underwriters or a cargo claims recovery company, you will be looking for club LOUs to secure your claim before the one-year time bar runs out. And effectively, that's just an undertaking by the club saying we will meet that claim in the event a liability is found against the member. It's effectively the equivalent of a bank guarantee. The advantage is for the member, of course, is that they don't have to go to a bank and pay a fee to issue the guarantee, and the letters of undertaking can be issued very quickly by the clubs to prevent arrest and disruption to the vessel. Importantly, though, a member has no right, as every club will tell you, to security. Every single LOU is issued purely on a discretionary basis. Now, the clubs will generally cover run-of-the-mill claims, but when there's any doubt as to whether the claim is within cover, you may find the clubs unwilling to issue an LOU. Right, let's look at some of the major heads of cover. Cargo claims we've dealt with, loss of life, personal injury. Fixed and floating objects cover, very much in the news recently with the Keyscott Bridge. Bunker pollution, that's pollution caused by fuel. Wreck removal. Repatriation and seamen's effects, so if a ship owner goes bankrupt and abandons the crew in the vessel, the P&I Clubs will usually step in and help to get the guys home. Or if somebody is ill and has to be disembarked at a port, the club will generally pay the medical bills and look after that member until he can be repatriated. Customs fines, so those of you who are dealing with sort of West African cargo claims, for example, know if there's a shortage on the manifested cargo, the customs authority will usually issue a fine, sometimes payable in cash, in the master's cabin, and the clubs will cover the member for that. There was, at the time the Bribery Act came into force in the UK in 2010, there was a little flurry of excitement as to whether or not the clubs were potentially in breach of the Bribery Act if they compensated their members for $1,000 paid to a customs officer to allow a vessel to sail, but I'm not aware of any criminal proceedings that have been brought on the back of that concern. Stowaways, big problem. Obviously, most ship owners will go out of their way to rescue people who are found drifting at sea. Big problem in the Mediterranean, obviously, as people are crossing from North Africa. The clubs, once a stowaway is on the vessel, repatriating those stowaways, finding somewhere to disembark those stowaways is a big headache for the P&I clubs, but they effectively take over responsibility for that. Very often the clubs will have to give a bond to the local authority to make sure that the places where they abscond, where they disembarked, are free from absconded. Unrecoverable GA, that's a slightly bizarre head of cover. Those of you who deal with cargo claims will know, so in the aftermath of a marine casualty, it's not uncommon for a ship owner to declare what's called general average. The precise legal status of general average is unclear, but it's effectively a term implied by custom whereby a ship owner can share a risk, share the costs of fixing what's called the common adventure, fixing the vessel and carrying the cargo to destination between itself, to an extent the charterer, and principally the cargo interests. The cargo interests will typically say, well, no, you're not entitled to recover general average contributions from us because you're in breach of Rule D, the York-Antwerp rules, because your ship was unseaworthy. If there is a finding to that effect, then the clubs will compensate the member to the extent it's been unable to recover, subject, of course, to the liabilities and exceptions in the club rules themselves. Some fines, legal costs, sue and labour expenses, and then something called the omnibus rule. So the clubs have a general head of cover that says at their discretion, the managers may cover the members for any other risk incidental to ship owning. So, for example, I once did a case whereby a member, younger son of a New York Greek ship owner, who'd had a previous career in the music industry, decided to let one of his father's ships, who'd called in Long Beach, out to film a heavy metal band video. One of the cameramen tripped over and broke his leg. Query whether he was a passenger, answer no. Was he a member of the crew? No. Was this a risk incidental to ship owning? Not really, said the club. So that was an expensive frolic. Quickly as to exceptions. Like any insurance policy, P&I Club rules have exceptions that void your cover if you're in breach of them. Very important, late notification of claims. Members, particularly those of you who work or instructed directly by a member, always ask whether they've told the club as soon as you're instructed. Most members will know this perfectly well, but most club rules will say that cover becomes discretionary unless notification of the claim is given forthwith. Forthwith means immediately, the event arises. The pay to be paid rule. Clubs will invariably have a rule that says we're only obliged to cover you once you've paid the claim in full. The reason clubs have that rule is to try to stop people suing the clubs directly, because they can then raise that rule against the member and say we have no liability until our member has discharged the claim. It was always the case that the personal injury claims fell outside the scope of the pay-to-be-paid rule on a customary basis. That's now expressed under the Third Parties Liability Against Insurers Act. But otherwise, the pay-to-be-paid rule survives that act. Matters covered by other insurance, marine war risks, hull cover, failure to maintain the vessel in class. So if, for example, she's had a certificate withdrawn and the owner hasn't told the club about that, that can void his cover. Illegal or imprudent trading, sanctions busting, smuggling Russian oil, increasingly an area of dispute. Deviation. Many ship owners will contract on the basis that their charterer has the right to rescind bills of lading and issue bills of lading for a new destination. Technically, that's a deviation as a matter of English common law. The clubs will say, we don't cover you in the event of deviation, because as a matter of English common law, if you deviate from the contractual voyage stipulated in the bill of lading, you void all your defences under the Hague or Hague-Visby rules. So the clubs don't cover them for that. What the clubs do in that type of situation is they will say, you have to take out what's called ship owner's liability, or SOL cover. Some clubs offer that cover themselves on commercial terms. Other clubs will arrange for that cover to be underwritten in the market. But the point is, the member has to tell the club that this is what he's doing. Falsely dated bills of lading voids your cover, irrespective of any causal effect between the false date and the resulting cargo claim. Delivery of cargo without production of bills of lading, likewise, very common that the charter party will stipulate that. But in the event the claim arises, the club has the discretion to say, no, we're not covering that claim. That's why the clubs offer what's called so-called recommended LOI versions to their members. Some members think that if they take out an LOI, that means their claim is still covered. No, it isn't. So an LOI is only as good as the person giving it. If it's two guys on a computer based in Shanghai, yeah, maybe not. If you're the ship owner, you'll sometimes see in charter parties, for example, owners guarantee that the hatches will be weathertight throughout the voyage. That imposes a liability which is greater than that imposed by the Hague-Visby rules. Club doesn't cover you in that event if there's a causal connection between that assumption of that liability and the loss. Willful misconduct. You scuttle your ship, you're not entitled to claim against your club. Losses incurred other than as a ship owner. Nuclear risks, carriage of live animals, not really something you're going to see too often. Specialist operations. This is sometimes something which one comes across in practice. Sometimes a ship will be asked to do something like pipe laying or tow a sonar fish for a seismic survey. If that is outside the normal scope of the member's cover, you fall foul of the special ops exception. Clubs do provide cover for offshore operations. That's on a fixed premium basis. It's not a mutual risk, and so falls outside the scope of mutual cover. What else do the clubs cover? They cover freight to marriage and offence. We've discussed those. It's effectively a form of legal liability insurance. It doesn't cover the substantive amounts in dispute. So your charterer doesn't pay freight. You can't go to the club and whine that your charterer hasn't paid freight and ask that the club reimburse you the commercial risks you own, but they will pay for the legal fees that you expend in trying to chase up the charterer. They also cover charterer's risks to the extent the charterer incurs these as a disponent owner. So a very important head of cover for organizations like the large grade training organizations, for example. They will take positions in the freight market. They will have at any stage 60 or 70 vessels on time charter. In many of those cases, they'll sub-charter out, thereby assuming the liability of a ship owner, and they will be covered for P&I risks, but they will also be covered to the extent they're entered with a P&I club for risks they incur as charterers. So, for example, if you're a charterer and you put dodgy bunkers on board a ship, and that ship, say, loses power, hits into a bridge, as a result of which the P&I club incurs a $3.1 billion liability, you are covered by the club for that, up to $350 million. That, I assume, is something which may be keeping the insurance managers at mercy of the charterers of the vessel that hit the Quayscott Bridge up at night at the moment. Damage to hull. So typically dangerous cargo, you put a cargo of HPI which catches fire on board the vessel. If you're entered with the P&I club for charterers risk cover, the club will cover you for that liability. Unlike ship owners, there's no obligation on a charterer to have P&I cover. Sometimes the charter party will say both owners and charterers warrant that they're entered with the club, but there's no obligation, law or statute, for a charterer to take out its own P&I cover, and very often charterers won't have that cover. There is, of course, a specialist charterers club called the Charterers Club, or now the MECO Group. That used to be a mutual association. It's not a member of the international group, but it effectively operates in a very similar manner to a mutual club. And of course, there are a large number of other commercial insurers who will also offer insurance to charterers on fixed premium terms. The club will give you specialist cover if you are involved in specialist operations, ship owners liability cover. Sometimes you want to cover additional assureds. So, for example, it's very common for the managers to be covered along with the ship owners. Let's end up with a small digression as to what happens when the members in the club disagree, because you may find yourself in this position. You may be acting. So when you are a solicitor, if you are instructed on behalf of the P&I club, all the club rules will say, although you instructed on behalf of the member, you also owe us, the club, a duty to keep us informed and tell us what's going on with the case. Most P&I club rules will say the lawyers can only be appointed with the club's authority, either given ex post facto or prior to the appointment. Sometimes the member and the club may fall out, particularly if there's a dispute as to whether the claim is covered or whether the member has acted prudently. In those, the initial decision as to whether a claim is covered is taken by the managers. Sometimes the managers will say, for example, when the owner presents a claim under the omnibus rules, says this isn't a traditional head of cover, but I'd like it admitted under the omnibus rules, the manager will say, no, we're not exercising our discretion to admit the claim. Sometimes the claim is notified late, and the manager will say, no, we're not covering this claim, or we're only going to cover the legal costs. The owners in that type of situation have a right to appeal to the club's board. The club's board of directors is typically elected every year. It's made up of managing directors or senior employees of some of the club's members. Tends to be some of the larger members. And that board will have a claims committee, which will sit typically 4 times a year. And it will determine whether or not to appeal any decision of the managers. So it effectively acts as a mini court of appeal if the managers have refused to cover a claim. If the board then decides, no, we're not going to cover the claim, most club rules provide for arbitration of disputes. So it is still open to the member to take the board and the club to court to arbitration and to argue in front of the arbitrators that the claim should be recovered. Very difficult thing to do, because certainly by the time a claim reaches the board, that is largely a matter of the board's discretion. And as you know, attempting to appeal the exercise of a discretion is a very difficult thing to do in law, but you do get the occasional arbitration of disputes between clubs and members. What is more common is that the club managers and the member will agree to effectively have the claim adjudicated. So they'll go to an independent solicitor that they both trust or barrister. and they'll say, do you think this is covered? He or she will say yes or no, and they'll abide by her decision either way. So that's a quick canter through P&I insurance.